All right, let's talk about Oportun Financial. They just dropped their Q3 numbers, and honestly, they're pretty telling. So the big question on everyone's mind is this: is their turnaround strategy finally paying off? Let's dig in and see what the numbers say.
Okay, first up, the headline number, 39 cents. We're talking adjusted earnings per share here. Now, why is that a big deal? Well, analysts were only expecting 26 cents. So yeah, Oportun just absolutely smashed those expectations. That's a 50% surprise beat, a really strong signal right out of the gate.
But you know that earnings beat? It only tells part of the story. This right here, this is the real headline. Look at that swing in profitability. Oportun went from losing $30 million a year ago to actually making a $5.2 million profit. That is a $35 million swing year over year. And this is crucial, it's their fourth straight quarter of being in the black on a GAAP basis. You can really see a trend starting to form here.
All right, so we've got the big earnings beat, but what about the rest of the quarter? Well, if you listen to management, they're calling this a quarter of just plain, strong, solid execution. And when they say strong execution, this is what they mean. Just look at this jump in adjusted return on equity. I mean, going from a measly 1% last year all the way up to 20% this quarter, wow. And listen, this isn't just some accounting trickery. This points to a really fundamental improvement in how the business actually makes money. It puts them right on track for their long-term goal of hitting that 20 to 28% range. Okay, now you're probably looking at this and thinking, hold on, revenue is down 5%. What's up with that? And yeah, you'd be right to ask, but this was totally expected. That drop is pretty much all because they sold off their credit card portfolio last year. The important thing is, even with that factored in, the $239 million they did report still managed to beat what analysts were forecasting. So you see all these good numbers, and it's clear this quarter's success wasn't just a fluke. It didn't happen by accident. According to management, it's all thanks to a really clear three-part strategy they've been hammering away at for a while now. So what's the secret sauce? Well, it boils down to these three pillars. First, getting much tighter and more disciplined with their credit. Second, just relentlessly chopping down those operating costs. And third, finding cheaper and more flexible ways to fund their operations. So now let's see how that strategy actually played out in the real world.
And here's the proof in the pudding, right? The numbers show this strategy is absolutely working. Let's break it down. Tighter credit? Well, their 30-day delinquency rate fell to 4.7%. And get this, that's the 7th straight quarter of improvement. Lower costs? Bam! Adjusted operating expenses dropped 12% year over year, hitting their lowest ratio ever. And cheaper funding? Their recent deals came in at some really attractive yields, which directly lowers how much it costs them to borrow money. You can see how each piece of this strategy is flowing right down to the bottom line.
Okay, so they had a great quarter, but what's next? What's management saying about the future? Well, listening to the earnings call, the best way I can describe their tone is cautiously bullish. They're happy, but they're not getting ahead of themselves.
Yeah, the CEO, Raul Vazquez, he pretty much laid it all out there. He said, and I'm quoting here, "Right now in this economy, it's important to try to decrease loan size and really focus on making payments affordable." So what's the playbook? It's simple. Tighten up those credit standards, shrink the average loan size. It's all about managing risk first and foremost, especially with so much uncertainty out there.
And a huge part of that de-risking plan is changing what their loan portfolio actually looks like. See, these secured personal loans, the ones backed by a car title, they now make up 8% of the portfolio. That's up from 5% just a year ago. Now, why should you care? Well, because management was very clear that these secured loans have loss rates that are more than 500 basis points. That's a full 5 percentage points lower than their unsecured stuff. That's a huge difference.
And this is where that cautious approach really pays off. Think about it. Even though they're tightening credit and maybe not growing their loan originations as fast, they're so confident in their cost savings and funding improvements that they're actually raising their profit forecast for the full year. Now that is a very, very strong signal.
Okay, but here's where things get a little weird. We have this strong quarter, we have raised guidance, so why isn't the stock price reflecting that? It seems like the market is looking at all this good news with a pretty healthy dose of skepticism.
I mean, the stock's performance tells you everything you need to know about what investors are thinking. In the 3 months before this report, Oportun stock just plummeted over 22%. Meanwhile, the broader financial sector was basically flat. That kind of massive underperformance screams that there are some deep-seated worries about the risks hiding under the surface.
And it's not just investors. Wall Street is completely split on this one. You've got the consensus rating sitting right at a hold, with just as many analysts screaming sell as there are whispering buy. Now, the average price target of over $8 suggests there could be some serious upside, but those ratings, they show a real lack of conviction from the pros.
So, we've dug through the quarter. We've listened to management. We've looked at the market reaction. What's our final verdict? What's the call?
All right, this is it. It's time for the next call. We're going to put a stake in the ground and tell you what we predict for next quarter, for the stock, and give you our final rating.
So for Q4, here's our prediction. We think Oportun is going to meet its guidance. But, and this is a big but, all eyes are going to be on their credit performance. Management has already warned everyone that net charge-offs are going to tick up to about 12.45% before they get better. So hitting that number without any nasty surprises is going to be absolutely critical.
And because of that big question mark around credit, we expect the stock to pretty much be stuck in a rut, probably trading somewhere between $5 and $6. The stock desperately needs a catalyst to break out, and that catalyst is going to be cold, hard proof that their credit tightening is working and that those charge-offs are finally heading back down. And honestly, we probably won't get that proof until we see the Q1 2026 report.
So when you put it all together, our rating on Oportun is market perform.
So let's just break down the why one last time. The bull case, the upside, is pretty clear. Management has a credible plan to get to a 20+% ROE, they've proven they can control costs, and their funding situation is getting better. But the bear case, the downside risks, are also very real. Their debt-to-equity leverage is high. We're talking over 7 times. Those net charge-offs are running hot at nearly 12%. And this business is just incredibly sensitive to what happens in the broader economy, especially for their customer base.
And as always, remember, this is not financial advice.